Assalamualaikum and a very good day to all viewers out there. To the returning viewers, welcome back. If you are my new viewers, welcome to my channel. We are going to discuss questions on Mfrs 140 investment property. Investment property here is equivalent to IAS 40 at the international standards. And this is for FAR270. We are doing question final exam, sample final exam, February 2021, question 2. And let us start now. Question 2A. Aurora Berhad is involved in the manufacturing of biscuits and confectionaries. On 1st January 2018, the company acquired a building in Pulau Langkawi. So 1st January 2018 is the date of acquisition, and you have this acquisition price of 7 million. There is also a legal and transfer fees of 500,000 and 20,000 respectively that were incurred in the acquisition of the building. The estimated useful life EUL of the building is 50 years. That was on 1st of January 2018. The building was rented out. This is the key word that you need to always try to look for. What is the building being used for, the function of the building? Immediately to Rania Berhad. So this is the third party, Rania Berhad, and the reporting entity is Aurora. And that was rented out for 388,000 per month. So that is later being used by the third party as a hotel. Our focus is on the point to the point of view of Aurora Berhad, that is using the building and the building that was acquired, that was rented out. So that is our point of view. And we're not looking at the point of view of Rania. So let us look at requirement A. Define investment property in accordance with Mfrs 140. So if you recall the definition, Mfrs 140 defines investment property as a land or a building or part of a building, or both. Both means both land and the building, that is held by the owner to earn rentals. And you can see that the keyword here was rented out, matched with the definition, or for capital appreciation, or for both. Both here means both rental and capital appreciation, rather than for. So this is not the investment property, so it is not used in production. The item investment property is not used in the supply of goods or services, not for admin purpose, and for sale in the ordinary course of business. So that was for 2 marks. Next, question 2B. And you are informed that the fair value of the building on 31st of December 2018, so look at the dates, and 31st of December 2019 were 7.990 million. That was for 31st of December 2018, and 7.828 million. That was for 31st of December 2019 respectively. Aurora, which is the reporting entity, adopts the revaluation model and the fair value model for subsequent measurement. So revaluation model for the property, plant and equipment, and the fair value model that is for investment property. So revaluation model and fair value model was for property, plant and equipment, and investment property respectively on its subsequent measurement, or the measurement after initial recognition. Required, you are asked to discuss the accounting treatment. Let me get my highlighter. Okay, discuss. You are asked to discuss This is the word. Discuss the accounting treatment of the building for the year ended 31st December 2018 and 2019. So meaning to say that you need to do that for 2 years, right? And you're asked to also prepare the journal entry. So if you look at the marks for the discussion is 4 marks, and the marks for the journal entries, that is 5 marks. So let's look at what you are asked to do is also for 2 years, 31st of December 2018. So let's look at the planning now before we start doing the answer. So if you look at 1st of January 2018, as per the information, you are informed on the initial cost actually. So the initial cost was the price itself, the lease price, 7 million, and this 500,000, that was, if you can check back before this, okay, just to show you, that was relating to the legal fees and transfer fees. So 500,000 is for the legal fees, and the transfer fees was 20,000. So that should be added with the acquisition price. So it should be added with the acquisition price. And if you do that, you would have 7 million plus 0.5 million plus 0.02 million. 0.02 million is 20,000. 0.5 million is 500,000. That will give you an initial cost of 7.52 million. And then you are also informed in the part B of the question, on 31st of December 2018, the fair value is 7.99 million. And that was after a year of being acquired. And as at 31st of December 2018, it was 7.828 million. That was the second fair value adjustment. And that was after 2 years that it is 7.828 million. This one. Next, you should know that during the fair value model, which is on subsequent measurement here, there will be no depreciation and there is no impairment. And the difference between the fair value and the carrying value, which is the initial cost, since there are no changes to it, that is going to be compared. And the same thing will be done for the difference between the fair value on 31st of December 2018 and also the fair value as at 31st of December 2019. And that comparison will be done. For the first year, it will give rise to a fair value gain. It is because there is an increase in the carrying amount from 7.52 million up to 7.99 million. In the second year, there is a fair value loss because there was a reduction of 0.162 million when you compare the carrying value, the new carrying value, which is now 7.998 million, the previous fair value, with the fair value on the date, the reporting date, which is 31st of December 2019, that was 7.828 million. If you compare that, you will get a fair value loss of 0.162 million. So therefore, that is the thing that happened. And if you were to do the requirement for journal entries that is in question 2B, if you can check the question, you will see that question 2B asks for the journal entries. So you should be doing journal entries for 2 years as per the requirement, right? So therefore, journal entries for the year ended 31st of December 2018 would include, number 1, the journal entry to acquire the IP, which is the IP building at 7.52 million initial cost, debit IP building, credit the bank or payable. If you have the name of the supplier, right, the name of the supplier, 7.52 million. So it should be 7.52 million here. Okay, 7.52, right? Not 7.5. There was a typo there. Next, the second one is to record the rent that has been earned by the company, and it was informed that immediately there was a rental income. So you can either debit bank if you receive it, or if that was just being earned but not yet received, you can go and debit rent receivable. And I'm doing this for 12 months, assuming from 1st of January up till 31st of December, that 12 months. So that was 4.65. If you are doing it monthly, you'll be repeating it for 12 months as well, which is 388,000 per month. And then you will record the fair value gain by comparing the fair value 7.99, like what I have mentioned earlier. So debit investment property 470,000, and credit the fair value gain also 470,000. And that is for the first year. For the second year, the journal entries would be for the bank, which is the record of the income, debit bank 4.65 million, assuming no change in the rental charge. Credit rental income 4.65 million. The next one is to debit the fair value loss, which is 162,000. That was to record the changes in the fair value. Let me just do this little correction here. I'm putting a comma here. Okay, so 470,000. That was the first part that need to do a little correction there. It should be 470,000. So there's a comma here. Okay, done. So the second part is the fair value loss, and the fair value loss is because the carrying value, which is 7.99 million, the previous year fair value, will be the carrying value in the following reporting date, and it will be compared with the fair value. You get 162. So that was for the journal entry part, and we can do it as early as the plannings part, right? Next, this is the answer for the discussion of accounting treatment. Remember, you can make use of this diagram that will help you with the discussion. So let's put that into words. For the year ended 31st of December 2018, we'll do that first. The building is classified as investment property. Why? Give the reason. It is being rented out. When? On 1st of January, that is the initial recognition date. At the initial cost, show the detail of the calculation, 7.52 million. How do you get the figure? And then mention about what happened on the subsequent measurement. Aurora Berhad has adopted fair value model. So therefore, on 31st of December 2018, mention about, or just write about the difference between fair value and the carrying value that was earlier recorded in the journal. So that fair value gain of 470,000, it will be accounted as gain or income in the statement of profit or loss for the year ended 31st of December 2018. Show the calculation, the fair value, and the comparison with the carrying value, 7.52 million. And then you have an option to also mention of the rental income, but here I do not mention since the marks allocated is just 4 marks. So I straight away mentioned the investment properties carrying value, which is carried at fair value of 7.99 million as at 31st of December 2018. But if there are more marks being allocated, you should also write on the rental income received or the rental income earned of 4.95 million in our diagram that we earlier planned for. Next one is question 2B is having 2B1 about two accounting treatment, which is for 2 years. So 31st December 2019, you just continue talking about the difference between the fair value and the carrying value, where you have the fair value, which is going to give you a fair value loss, 162,000, and that is expense of in the statement of profit or loss. And then the investment property is being carried in the statement of financial position at the fair value of 7.828 million. And for both years, 2018 and 2019, there is no depreciation, no impairment. Of course, is provided for the investment building, the investment property, since Aurora has adopted the fair value model. Okay, these are the journal entries that I've done earlier, but this is the one that is given marks in the particular question. However, you will not know how much marks will be allocated, so just be safe by writing or also including the journal entries on rental income for both years. But I've done that much earlier, right? Okay, this is part C of the question. I've made some addition here. I have changed the date. So in 2020, this is the part that I have made some changes. The management of Aurora Berhad made a decision to diversify into the hotel industry. So they decided no longer to use it as an IP, but they want to use it as an owner-occupied property and involve as hotel operators. They gave Rania 6 months notice to vacate the building. So Rania is given a notice to let the building now, and eventually on 1st of July 2020, the company began its hotel operation using the building. So now there is a transfer of, in terms of, there is a change in use from investment property into, remember before this, when you rented out to Rania, it was an investment property. Now you want to use it again by yourself as a hotel, and therefore that is going to be an owner-occupied property. On this date, the fair value, this date refers to 1st July 2020, the fair value of the building was determined to be 7.920 million. You are required to advise Aurora Berhad on the accounting treatment of the transfer of the investment property. So the question clearly mentioned about the word transfer, and you need to discuss on the transfer accounting treatment for the transfer only on 1st of July. You do not need to discuss things which happened up till 31st of December 2020. You are just asked to explain the accounting treatment on the transfer on 1st of July in accordance with Mfrs 140. Remember, under Mfrs 140, much earlier, the company is using the fair value model for the subsequent measurement, right? So that is for 5 months. That's what we have to do. So I made some diagram for you. Date of transfer is 1st of July 2020. The current financial year end is 31st of December 2020. That is for 6 months. The current period that you have is just 6 months, half of a year, because it starts on 1st of July. On this date, the remaining useful life was 47.5 years, because on 1st of January 2018, it was 50. So if you do some calculation, you will get that to be 47.5, because this is 1st of July 2020. Next, transfer. So what is the transfer? It was a change in use from building, IP building, rental use initially, now is being changed, and that is going to be held as hotel, right? So that is an owner occupied property. It is a PPE. So look at the carrying value. So the carrying value is the previous carrying value before the date of transfer was 7.828. And the fair value of IP, the investment property on the date of transfer, from the information given early just now, it was 7.92 million. So there was a gain on fair value change between the carrying value and the fair value of IP. You make a comparison, and that gain on fair value change was 0.92 million. This happened on the date of transfer, and remember, we are transferring IP, the investment property, to now becoming a PPE. So therefore, the fair value of IP will be the deemed carrying value of the PPE, the fair value of IP on the date of transfer, right? And the gain on fair value change of 0.92 million will be recognized as other income in the SOPL. So in the SOPL means for the year ended 31st of December 2020, that current year. And starting from 1st of July 2020, depreciation will start. Yeah. So if depreciation will start, it is because it is no longer an IP. It is now a PPE starting from 1st of July 2020. So let's say if they are to depreciate on 1st of July 2020 up till 31st of December 2020, that will be for 6 months. And the journal entry on the date of transfer, the journal entry on the date of transfer, which is on 1st of July 2020, you are going to debit building a PPE with the 7.92 million. That is the deemed cost, the carrying value of the IP is the deemed cost itself, 792 million. Credit investment property 7828, which is the previous carrying value, and the difference between the previous carrying value and the fair value on the transfer date is the fair value gain that will be credited to the SOPL as an other income. And this is our discussion where you can make use of the diagram, and you can refer to that diagram just now and write your discussion. Or the discussion here is discussion of accounting treatment just on the date of transfer, 1st of July 2020. There is a transfer from IP to PPE as there is a change in use. Give the reason why there is a transfer. The reason is because it was held as a building before that, from held to rental, and now becoming owner-occupied property, which is hotel operation. The difference, you need to mention about the difference between the fair value at the date of transfer, 1st of July, of 7.92 million, and the previous carrying amount of 7.82 million. That difference of 92,000 is credited as a gain on fair value in the statement of profit or loss for the year ended 31st of December 2020. So that is the one happening on the date of transfer. And thus the building from the date of transfer onwards will be accounted as owner-occupied property, and it is recognized as PPE in accordance with Mfrs 116. So the building now will start to be accounted as PPE, and the depreciation will have to be done by the company depending on the remaining useful life. And the deemed cost of the PPE, because the subsequent measurement will only take place for the revaluation model, but on the initial recognition, for example, here deemed cost of the PPE shall be the previous fair value of 7.92 million, which is the one given in the question. From here onwards, the PPE building shall be depreciated over its remaining useful life of 47.5 years. You do not need to discuss up to what happened after that, because that is not required unless required. Okay, with that, I thank you for watching. I'll see you when I will see you, and have a good day ahead. Assalamu alaikum.